we believe big tech is a huge driver of commodity demand, whether it's demand for electricity, the underlying commodities required to create data centers. So that's steel, rebar, concrete, all sorts of infrastructure.
Brandon Ducharme is an investment advisor representative of and offers investment advisory services through SCF Investment Advisors Incorporated, an SEC-registered investment advisor, 10150 Meanly Drive, first floor, San Diego, California, 92131, 800-955-2517, www.scfsecurities.com. SCF Investment Advisors Incorporated and Ducharme Wealth Management are separate entities. The information in this podcast is current at the time of recording. It is based upon sources and data believed to be accurate and reliable. The information, opinions, and forward-looking statements expressed herein are subject to change without notice. Moreover, all comments and opinions voiced herein are for informational and entertainment purposes only and are not intended to provide specific advice or recommendations and should not be interpreted as such. Further, the opinions expressed are Brandon Ducharme's and his guests and do not reflect the views and opinions of SCF Investment Advisors or any of its affiliates. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what is appropriate for you, consult your financial professional. This information is not intended to be a substitute for specific individualized tax or legal advice. Ducharme Wealth Management and SCF Investment Advisors do not provide legal or tax advice. These services are provided by separate entities. The guest speakers featured in this podcast are not affiliated with SCF Investment Advisors, nor are they affiliated with Ducharme Wealth Management unless otherwise indicated.
What is the difference between trading the financial markets and trading commodities?
Well, good question. So when I think about trading the financial markets, and so definitely had training in that area. I went through the TD Trading Development Program in Toronto straight out of undergrad, and you rotate through a bunch of different areas. So, bonds, money market, currencies, not so much on the equities. That was a separate business than that. And then commodities and sort of everything else was kind of this separate, mysterious thing. And what's the difference? I think when you focus in the financial markets, you focus on some area and become an expert in it. It could be fixed income or a certain part of the curve, or a certain types of equities. And this is where my expertise, healthcare, just picking that randomly, oil and gas. Whereas in commodities, you could go specialist, and definitely I had that experience once I got to Shell. But the way we looked at it was commodities are this highly diverse asset class. There is no more diverse asset class than commodities. Cotton is not like crude, is not like coffee, is not like canola. I say that often. Very diverse asset class with incredibly unique opportunities. And if you can master risk management and that kind of discipline, it is a great area or a great sandbox to play in, given that diversity, given all these different things do such different things at different times with different drivers. I mean, the drivers of futures in, I'll pick something really esoteric like sunflower seeds or milk or cheese, don't really ebb and flow with the price of crude oil typically. So to me, that is an incredible opportunity to try to extract value in some way. You got to figure out what your way is and learn a discipline. But that diversity is just massive. Now, the commodity markets are volatile. People say, well, that's a difference. But look, the equity markets are volatile. This week reminded us all about that. So there is volatility there for sure. I think it scares people often because typically commodity markets are traded through futures contracts or over the counter, but the most common way would be through futures contracts. And as soon as you say futures contracts, that scares the general public. Mm-hmm. It shouldn't. In fact, elsewhere in the world, other than the Western world, so say North America and Europe, futures contract trading is very typical. If you go to Asia, we'll pick on China. Futures contract trading is typical for the retail investor. And so, and I'll even give you a data point. The most liquid futures contract in the world is a Chinese futures contract in rebar, steel rebar.
Wow.
That's the most liquid contract there is. And it's traded by mom and pop, so to speak. Just like we may speculate Nvidia or something. That's where they play.
And just to clarify for, a futures contract is not the way that they're traded and the way that you get them and the way that you access them. Yes, there's complexities and nuances to that. But sure. If I went down to, the farmer down the street and said, I would like to, could I buy, basically could we have a contract that I'll pay you $100, right now. And it kind of in exchange for that, we're going to have a contract. I'm going to buy all of this corn from you in your field. Sure. At the end of the season,
in the fall when it's
ready, and I'm going to buy it at a dollar a piece of corn or whatever, and so at the end of the season, you have to deliver the corn to me, and I have to give you $1 a piece for it. Like that's all a futures contract is. It's a contract for an exchange that's going to happen in the future. Yep.
That's right. And this is where futures contracts were born out of. I mean, you nailed the issue. Is it was born out of the need by producers of commodities. And yes, it literally started with eggs, where they wanted some stability in terms of their future pricing, and the ability to hedge. Here's another really important nuance about this. And this one's really critical that really gets missed by a lot of people. And that is, what is the motivation in the futures market? Say with commodities, let's just keep picking on commodities here, and that farmer or that oil producer or that miner. Many of the participants in the commodity futures markets are there to lose money. So let me reiterate that. People participating in the futures markets are actually there to lose money. How could that possibly be? That seems so crazy. Well, what they're doing is they're using futures contracts to hedge. So they produce something, that corn by that farmer, or silver or gold or whatever it may be, and they produce a bunch of that. And they may hedge some of that by using a futures contract. And if that futures contract goes down in value, they've gone up in value in that underlying production of whatever they're producing. So it's a good thing, right? That's their hedge. And that means that the price of whatever they produce has gone up or been stable or, whatever. So the motivations in the commodity futures markets are not exactly what people think. People say, well, isn't it a zero-sum game? Well, of course, everything at the end of the day is kind of a zero-sum game, whether it's the financial markets or the commodity markets. But in this case, many participants in the commodity futures markets are there to actually lose money because of the hedging principles. So who picks up that difference? Well, it's speculators in some capacity. Whether you call a speculator a group like us who looks to trend follow markets up and down, we've got different motivations than what that user of the futures contract is, that original user. And so that's a structural, so one of the structural differences in this space. Now, that doesn't mean it's easy. What it means is there's different motivations in the market, which could create volatility, which could create spread, which could create different alpha opportunities in the commodity market.
Yeah. A lot going on there. You obviously have been doing this for a long time. Tim, highlight really quick for me. Remind me, you started your career. So you touch on, you were at TD Bank up in Canada. And then from there, what'd you do after that?
Yeah. So TD Bank, straight out of undergrad, went through the trading development program, stayed for 5 years, ended up on the proprietary desk, which my focus was commodities. And in fact, if you actually pigeonholed what I did, a lot of what I was focused on was the energy markets. This is circa the late 90s. And this is kind of germane to the next step, and that is if you think of the mid 90s, it was NASDAQ.com. It was, the .com, what became the bubble towards the end of the 90s, early 2000s. And that was a great opportunity to participate in these commodity markets, which were becoming more mainstream, kind of more sexy. The Bitcoin at the time was natural gas, and it really gave a opportunity set for me to hone my craft, especially from a risk management perspective. So from TD, I went to Shell. Shell was an opportunity to focus in a segment, i.e. energies, and bring Shell investment and trading for the house. I didn't trade for anybody else. I traded for the house, if you will, trading their money, trying to provide non-correlated returns to what other fundamental energy traders were doing for Shell. So Shell's a big trading shop, as is BP and many others. A lot of the traders there are participating in a fundamental way, pipeline logistics, this type of thing. What they wanted was participate in the energy markets, but in a non-correlated way. So different drivers. So trade crude and natural gas, if you will, but do it and produce results that are accretive to the overall portfolio. This sounds a lot like what CTAs do. Of course, I didn't even know what that meant. So how did I go about that? Well, it came through a trend following, disciplined risk management, understanding volatility. Some option trading was a key part of what we did. And so Shell was really diving into that volatile energy space circa early 2000s. Merchant energy, think back, this is the Enron time, was a great opportunity, extremely volatile. And so I stayed with Shell for 5 years and went down. I was in Calgary, then went down to Texas, to Houston, became VP of trading for North America on the derivative side, and then decided to move home in 2004. We had our first child when we were in Texas. And then decided to move home for a couple of reasons. One, family. Two, I wanted to eventually hang my shingle and create a company, and that became Auspice. And so I left in early 2005 to create Auspice.
What are some of the lessons that you learned working those desks about the volatility control of commodities? Because that's something that when I talk to people about commodities, they often say, "Oh yeah, I know somebody that traded commodities, and they said it's the riskiest thing you could ever do."
Past tense.
Yeah, right. And so there's all this misconception out there, like and I think that's because obviously we both know that's a derivative of the leverage that people use oftentimes when they're trading commodities,
Sure.
right?
Yeah.
Or the complete lack of volatility or risk management.
That's right.
Yeah. But what are some of the lessons that you learned, on the desk there on risk management and volatility control?
Well, that is the lesson, right? When I was at a big shop like Shell, most people, as I mentioned, are trading in some sort of fundamental way. They've got a view based on some sort of research, whatever driver they had. And that creates big volatility in their positions. There could be big wins, big losses. And my approach coming out of the bank, TD Bank, previous to Shell, was all about risk control, right? You became a risk manager first, and then you tried to figure out, what kind of strategy appeals to you and your mind and your discipline, and what markets, whatever the case may be. So those combination of things, but it really started with risk management. My approach was really simple. Risk one to make three. Do it again, do it again. It's discipline. At the end of the day, it's gaming theory. It's like being a professional poker player, right? You're looking at the odds. You're looking at the discipline. You're making bets in a careful way. But job one is to protect the pot. Capital preservation. And so that was the lesson. Is longevity in the space is based on risk control and discipline. And that led me more and more in my career from the beginning at TD and then on to Shell to more systematic rules-based approaches. We knew fundamental drivers. We knew kind of what worked. So for example, term structure, do you want to be long in the front of natural gas, or do you want to push that further back based on the shape of the curve, contango and backwardation, and coming up with rules-based approaches to increase the discipline and the consistency. The commodity markets, as you said, in many markets are super volatile. And so how do you become more consistent at them? Well, it's risk control, and it's that rules-based approach. This is not to in any way talk down about fundamental approaches. Some great fundamental traders, but I think the commonality with traders and investors that last a long time is that the risk management is really disciplined and rules-based. You can be fundamental in your view and how you get in and out of a trade, a stock, a bond, a commodity. But when it comes down to risk management, if you're going to last, you have to be rules-based discipline on that risk management and capital allocation part. So that was the takeaway is I had patience and wanted to last a long time in this business. I wasn't in it for the flash. I wasn't in it to, hopefully hit a home run or blow up and go home. I was trying to create a discipline. I hired my now co-founder at Auspice, Ken Corner, in 2000. So we've been trading almost 24 years together. And it was all about creating a discipline, creating that rules-based process, and lasting, right? Waiting patiently for our opportunities. It could be, natural gas goes to sleep, but if you're patient, there's going to be some sort of opportunity. Don't sell a bunch of volatility and blow up when things move because it was quiet. So it's all about creating that discipline.
Yeah. Well, I think there's a lot of people out there selling volatility right now. That's been a very big,
sure,
a very big trade in the market that has.
Well, it's good trade. I mean, we were short. This funny. This just came up. Somebody was asking us about this in the last, obviously about the last week and what's gone on. And
yeah.
I said, well, look, being short VIX was a great trade for a long time. We were short VIX the bulk of the last couple of years. And we exited third week of July, got out of that. So we were neutral to VIX. We started cutting some of the equity positions, NASDAQ, for example, in July. And last Friday, a week ago today, we went long the VIX. And that trade lasted very little time. We went long on Friday, and we actually exited on the evening of August 5th, Monday, about 1 a.m, we exited our position, as it spiked and then started to kind of stabilize. We exited that long position. So it all sounds great. Selling vol sounds great until you have one of these spikes that are very hard to predict and you blow up your portfolio. And that's the thing we're not willing to do. It's being very disciplined in our positions.
Yeah. So, you ended up developing the Auspice commodity index, broad commodity index.
Correct.
And that is a rules-based strategy that so this is a verified index. And it goes, from what I understand, long up to 12 different commodities, or you can pull back to cash. And change your weighting amongst those. Is that accurate understanding?
Yeah. I mean, so let's back up a step. So you nailed the issues. Like, what was the motivation to create this index? So we did it back it's over 14 years ago.
Okay.
We were working with an ETF company called Claymore, if you remember. And they had U.S. operations and Canadian operations, and they were looking for a way for investors to participate in the commodity market upside, but they didn't want the volatility, or they didn't want a product that had the volatility of, say, the Goldman Sachs Commodity Index or the Bloomberg Commodity Index. So long only, big basket of commodities, super volatile. If you get it right and it goes up, great, but it corrects, and those corrections are violent and volatile. So the motivation was, could you participate on the upside in commodities? And we'll get to the motivations and why you'd want to do that in a bit. But could you create that type of a vehicle that outperformed Bloomberg and GSCI? And the answer was, yes, we believe we can. Are we going to do that? Or we're going to use trend following, right? So we're good at trend following in our overall CTA business. We want to participate in commodities that are moving up, and we want to go to cash or reduce that downside, in this case, by going to cash in markets that are going down. Now, I don't want just all commodities, right? Like the Bloomberg Commodity Index, you got all those things and you're long all the time. I don't want that. I want to be long the ones going up, and I want to be on the sidelines in the ones going down. So it's based on merit, and that merit is defined by trend. Is it moving up or is it going down? So there's your first step. And the second step is, well, let's size those positions. And what's the capital allocation like? Let's size those positions based on volatility. So we're going to normalize the risks. So say something like natural gas, which is much more volatile and gold is not, but we want equal bets in those. We don't know which market it is going to go. We don't have a crystal ball. So we want to normalize those bets and those risks across those markets. So that's the second step. And then we want to look at those markets from time to time and say, has that market got more volatile? Natural gas started at 30 vol, now it's trading 130 vol. Maybe we should resize that because it's an outsized position in the portfolio. So that's your second step. And then your third step is term structure. If I'm going to go long natural gas, do I want to be long in the front, or do I want to push that further back based on contango? That negative roll yield when I have to sell a contract that's coming to expiration and I have to buy a new contract and it's at a higher price, that creates a negative roll yield. So there's some negative implications there. So let's take those three steps and let's put that in an index-based strategy. Well, rules-based manager, it's not such a quantum leap to create an index. And so we took our strategy, we created the documentation and the rules around it, and published an index. It's been, the NYSE has been publishing that index since 2010. So why would we want to publish an index? Well, now we have sort of our own benchmark. If we deviated in the fund, or if somebody was mimicking the strategy and they deviated from the underlying index strategy, you would know, because you'd see a difference in performance, you'd see a difference in the weightings of an individual commodity. So you want that benchmark. And so we started publishing that. That was kind of the leap that we were taking. And so the strategy has been around a long time. And but those are the principles.
Yeah. Well, let me back up. I like commodities from a non-correlation standpoint. I think there's a lot of merit for why people should consider that as an opportunity, right? Like, you shouldn't discredit it, just like you shouldn't discredit really any asset class without doing proper analysis and understanding, obviously if it fits your, goals and objectives. But for myself, I look at, and there's a low correlation, right?
Exactly.
The things that drive, the price of one commodity, like cotton as an example, is entirely different from what's driving the price of, Apple stock or something, just like as an example. It's like there's two totally different things. And there's all kinds of things that can affect commodities, right? Weather being a huge one, right? Macro environment conditions, global tensions.
So it's a long list.
Oh yeah. And so it kind of creates all this opportunity. Sometimes I think of, people say, well, okay, that if there's all that volatility in commodities, well, volatility is, it's opportunity. Volatility is two things. One of the biggest takeaways I've ever had talking to an institutional manager is when John McClure told me, volatility is leverage. Don't ever forget that. And like, volatility is opportunity. So commodities can produce either of those things, right? But there's also a lot of different changing. There's been a fundamental shift in the macro environment, I think, just of the world, right? All of these drivers seem to be changing. And it seems to be that there's a different environment around commodities. And some of the things that you've talked about, or I've heard you talk about in the past, is the commodity super cycles.
Right.
And so what's your take on what's kind of going on in commodities markets, and where we at, and how does that tie back to inflation, and what does that do for commodity markets, in the future here?
So there's a lot to unpackage there, but I'll give you my 2 cents. So let's start with the idea of a super cycle. if we look back at commodity cycles, and so we could just pick something simple like the Goldman Sachs Commodity Index. If you look back historically, you can see that these commodity cycles are long. There's some structural fundamental reasons for that, and we'll talk about that in a second. But these cycles are long. When we look back at cycles over the last 50 plus years, generally these commodity cycles last about 10 years. Within that, they don't just go straight up. It's not an escalator up, okay? So it doesn't just go one way. There's pauses, there's pullbacks, for all sorts of reasons. But they generally last a long time. So we can recognize, that could occur. What are going to be the catalysts to create these commodity cycles? So when we think about it, we kind of boil it down to two core things. There's two basic ingredients for a commodity supercycle. One, an extended period of underinvestment in supply of those commodities. So think of investment in the oil space, or energy space in general, mining, and a whole bevy of other markets. But let's just pick on, say metals and energy, because it's kind of easy to do. So when we look at capital expenditures in the commodity space, in oil and gas and mining, we see that it has been in decline since about 2012. We can talk about why. It's generally because prices got really high, and then a bunch of investment comes in and it starts to decline. There's other reasons. There's green pressures and ESG pressures, lending pressures in those sectors. But at the end of the day, kind of does or doesn't matter. What we know is the expenditures in those spaces has been in decline. So that's the setup. The setup is always the same for a commodity cycle. We haven't been spending enough on extraction of those commodities for whatever reason. Mm-hmm. Now, that doesn't mean the commodity markets are going to rip at that moment. You need some sort of generational demand shock. Early in my career, as I was talking about in the mid-90s, I was stepping into a generational demand shock that I was completely unaware of and naive to, and that was China. So China became that generational demand shock in the cycle that started in the early 2000s. China, there was not enough capital expenditure in the areas, there wasn't enough commodities, if you will, and here China went and built infrastructure on a incredible scale. So that became the catalyst. When I look at the catalyst now, so the setup's the same. We've had that capital expenditure decline since about 2012. People say, well, it's on its way up. I can tell you that the blip we've seen in terms of capital expenditure in this space, say in the last few years, is truly a blip. We've maybe stopped going down, but it's not like we've seen it spike the other way. So the setup's there. What becomes the catalyst? When I look at the catalyst now, it's such a long list. So I'm going to just whip you through some of our things that we talk about. There's green transition, decarbonization, ESG, stakeholder capitalism. These things all put pressure on the commodity markets. You got supply chain complications everywhere we look. Mm-hmm. You've got the highest number of global conflicts since World War II. You've got rising nationalism and populism. So nationalism, and I'm not trying to be political here, but when countries protect their own, it creates volatility in the commodity space. It may take certain commodities off global markets and change the fundamental story or the potential for higher prices. I'll give you an example. India has weaponized a number of commodities in the last few years, given their growth. Then you've got commodity investments and inflation protection as a whole. So why do I mention that? What I mean by that is that many investors, both retail and institutional, hadn't used commodities for the better part of a decade in a great way because there was no inflation. We were in a period of no inflation. We had quantitative easing, and they weren't really worried about inflation. And so there wasn't a big investment in that area. We've seen that change, and I'll come back to that. Then we've got rising interest rates, which happened over the last few years. We'll see what happens next. But rising interest rates, raising interest rates to battle inflation, as we've seen the central banks of the world do, can do something. It can reduce demand for manufactured goods, right? So there's demand pull and cost push inflation. Demand pull inflation is demand for manufactured goods, and if you raise rates, then we spend less. What raising rates doesn't battle is cost push inflation driven by commodity prices and wages. So what do we see going up? Wages, and they can't control the commodity cycle. So raising interest rates doesn't help this problem. It actually exacerbates the problem. It doesn't increase short-term commodity supply, and it surely doesn't incentivize long-term commodity projects. So that's a problem. Then we've got labor shortages, unionization, aging demographics. How many kids want to get out of their parents' basement and go work in a mine? Doesn't happen much anymore. Now we've got some demand shocks, and I'll leave it at this one. We've got emerging demand shock one, we believe, is India set to surpass China as the #1 commodity consumer in the world. Emerging demand shock number two is big tech. This one doesn't get talked about. I've written about it. You can Google the articles that have been written by us on this. We believe big tech is a huge driver of commodity demand, whether it's demand for electricity, the underlying commodities required to create data centers. So that's steel, rebar, concrete, all sorts of infrastructure. You've got EVs. All of these things are putting pressure on the commodity system or commodity supply and demand balance. Computer chips, as an example, and the metals required. So all of these things are, we believe, emerging demand shocks. And then I'll leave you with this one. And we know this one well in Canada. Government policy is not conducive to resource development. It's getting harder and harder to be a commodity producer, especially in the Western world. So all of those things combine to be cycle drivers. They all contribute in some way, more or less. But I've never seen a commodity cycle that had so many drivers. Now, that doesn't mean we're going to go straight up because we've been pretty quiet the last couple of years. But we believe this will exacerbate this commodity cycle and really makes us bullish in a way. Doesn't mean we're just long and putting our head in the sand. We believe it's not only the upside potential, it's the two-way trading. Because of those factors, say weaponization of commodities, there's going to be ups and there's going to be downs. And that's an opportunity for a trend following, disciplined, rules-based trader. So there's a big, long-winded way to answer your question. The setup's the same, lack of CapEx, and now we have a bunch of drivers. They're going to come in different, in different time frames, but they create an incredible opportunity.
That is a lot of opportunity or potential opportunity.
Potential opportunity.
Yeah. I think one of the interesting things that I picked up on there was when you were talking about the difference between the cost push, right? Versus trying to artificially slow inflation with rising interest rates. Can you kind of unpack that a little bit more?
Yeah, well, I mean, raising rates is potentially effective for demand pull inflation, right? Again, how do we slow down an economy? Well, you raise rates, and then you and I and mom and pop spend less. That makes sense. And the central banks have used that tool for a long time. If we look back to the 60s, 70s, and 80s, we had CPI go all the way to the high teens. Central banks, let's pick on the Fed, raised rates all the way to almost 20%. And that slowed down inflation. Argue did a couple other things. It actually killed the global economy because when you raise rates to 20%, there's some negative effects. I don't think that's necessarily going to happen. But what we did see was central banks raise rates, trying to battle inflation, driven by all these factors. But what they don't have is an effective lever for cost push inflation. So that's the price of commodities and wages, generally kind of key factors in the cost push inflation equation. And so I think that what they have to do is kind of change the narrative, and I think they are. And so it comes with some data points. If I ask the average person, what's the average CPI over the last 100 years, they generally answer with a pretty low number. And I think part of this is because the central banks, the Fed, has said our target is 2% or something like that. Where did 2% come from exactly?
Cows.
I will tell. I'll tell you this, the average CPI over the last 100 years is 3. The average CPI since 1970 is 4. So where are we getting 2 from? And so I think they start to change the narrative, and I see this in other central banks outside of the United States, where they're starting to change the narrative, saying, we don't know if we're going to get back to 2%. They can say that's the goal, but we've got to start reducing rates, for other reasons. And that's what we're seeing. Yeah. So this inflation is not just going to go away, in my opinion. It's going to stay somewhere in the 3+% area. That is normal. That is the average of the last 100+ years. And I don't think it's going to be 7, 8, or 9. I don't think we're going to some sort of Argentinian or Venezuelan situation. But they had to start to adjust rates in advance of that, because they're recognizing they don't have control of this part, cost push inflation. And so that's what's happening. We're starting to see it with many central banks. We haven't seen it with the Fed yet. Is it coming? Probably. But that is, part of what we need to recognize. Ask anybody. It doesn't matter where you live in North America or even in Europe. Is inflation gone away, or is it 2%? Come on. It's not. That's ridiculous. So I think we need to recognize these things. We're starting to make the adjustments. Now, here's the key part out of that situation is, what do we learn about these inflationary environments and what works to hedge assets? Well, we all want equity upside. And if we look back over the last almost 100 years, say post-war, World War II, that at times of normal inflation, so say from 1945 on, was really a period of sort of normal inflation and growth. And what we noticed at that time, and this went all the way to about 2000, is that stock and bonds actually, are fairly highly correlated during normal inflationary times. Problem is that most of us came into this industry, say, post 2000. Mm-hmm. And from that time, bonds and stocks, bonds diversified stocks, because we had very little inflation for all sorts of reasons, including artificial reasons like quantitative easing. Bonds did a pretty good job for the better part of 20 years. But what are we seeing now? We're seeing stocks and bonds again moving together, because I believe we're back in a normal inflationary time. So I don't believe we're in an outlier time since 2020. I think we are really been pushed back to what is normal, and that is normal inflation and what hedges what. So why do I bring this up? What we see out of the institutions is the recognition that bonds aren't going to be that hedged. So they're dropping their fixed income exposures and looking for non-correlated assets. And what are they going to? We're seeing commodities come right up, because it is, as you started this conversation, non-correlated to other asset classes. And I'll pick on one. Ontario Teachers now has a 10%-ish portfolio directly in commodities, not resource equity, not resource debt, in commodities, because commodities have hedging principles, a low correlation, plus can have positive returns depending on the strategy. And so they're looking for those type of things. So we're seeing that shift in terms of investment in the area. It had been low because we had no inflation, and now we're back to normal inflation. We believe that's going to persist regardless of what the central banks do. And if that's the case, you need something other than bonds.
It's interesting that you say that institutions are taking bonds off the table, so to speak. I hear everywhere. I always feel sometimes like the lone guy in the room when I've
being a commodity trader.
Well, yeah, I'm not that lone guy, but in a lot of what I had done, I really paired the duration risk out of portfolios going into 2022 and earlier in 2022, and everyone said like, well, you need to be taking on more duration risk, and there's these large institutions, so I don't want to name any by name, but they'll bring out their forward projections, and they'll bring out their stuff that they release to the public, and they're saying, well, you should, it's a great time to buy all these, long duration bonds, and I just don't. I'm having a hard time seeing it because the correlations have changed so significantly, and that is something that people forget too. Is that correlations change? You don't have, the correlations change over time, and it depends what smoothing principles you apply to that, and what time frame you're looking at. But
Look, at the end of the day, none of us have a crystal ball.
yeah,
We don't exactly know where things are
uh-huh,
going. And so you have to say, how do I diversify this portfolio in a way that is effective? And so you have to look at some of those hedging, numbers and correlation numbers,
yeah,
sorry, that actually are the truth. And in this current environment, it may be different back in
yeah,
2010, post the global financial crisis, and given how central banks reacted. But we're not in 2010. We are in a very different environment with a very different world. Think of all those factors I was talking about.
mm-hmm,
And so we have to adjust. And we are seeing those very conservative um, global pension plans. And the great thing about the pension plans, you take it with a grain of salt. What are they trying to do? They're trying to be very conservative, protect the capital of, say, teachers, policemen, fire, nations like Canada Pension Plan. So they're being very conservative, and they're looking at the facts. They're not looking to introduce volatility. They're looking to mitigate volatility, and they're looking to build a better portfolio. So if they're bringing commodities up at this time, that should be a flag to say, well, why is that? Well, because commodities have a low correlation, and maybe bonds aren't going to be as effective here, and just kind of put those data points together. And that changes. We can't just bury our head in the sand and say, what worked from 2000 to 2020 is going to work forever. That's not the way this works.
yeah. It's a very changing world out there. That
It's
much I am certain of.
that much I'm certain of. And I mean, you're really hitting why I became, focused on commodities in my career, because there's so many diverse opportunities and it keeps changing. As I said, natural gas was the Bitcoin at the time back in the, late 90s, early 2000s. You know, it, it also can be a very sleepy commodity. I'll tell you a story. I mean, the longest trade we've ever had at Auspice in our 18 plus years was short natural gas. We were short for over 1,000 trading days
Wow.
in our portfolio. Natural gas was going down. We just kept rolling the curve, earning the contango and being patient. If you were looking for excitement in natural gas, for years there was nothing there.
That's 3 years.
3+ years. So for us, this is part of the reason we left Shell, to say, hey, we've got a discipline, we've got an approach. We honed it in very volatile energy markets, which taught us incredible lessons. But we want to diversify beyond, say, just the energy tilt, because those same principles apply in other commodities, and those same principles apply in the financial markets. In our flagship CTA, which has been around 18 plus years, we still have equity index exposure. We're not stock pickers, but equity index exposure, bonds, and currencies. And they're primarily there as a diversifier to ride the commodity ride. They do something different. So you put those assets together, it's a more powerful portfolio. We still want the commodity tilt, but there's times when commodities a tough, quiet area, choppy volatility. We went through a decade of that. You need some of those other things to help sustain. It's just global diversification.
This is more of a fundamental question, but what's your thoughts around the effects of kind of the US dollar hegemony coupled with the kind of commodities forecast? Like what effect does a strengthening or weakening dollar have on commodities in general?
So this is a great question. I think what people often go to on this is we need a weak US dollar to have a commodity market, move higher in general. And I can tell you patently that is not necessarily the case. I mean, look at what we've seen in the last few years. We've had an extraordinarily strong US dollar, and we had a commodity market ripping. And so I don't subscribe as an investor to those type of rules of thumb or, benchmark type ideas.
Mm-hmm.
I look at those things independently. I may trade in our CTA, the US dollar vis-a-vis other currencies. We look at commodities independently. I can understand the fundamental theory on that, in terms of purchasing power in US dollar, but the world is changing. The importance of other currencies is changing. You can't deny the importance of India and China. And so I don't subscribe to those type of rules of thumb. I'll give you one pick on commodities for a second. You say there's this benchmark between, say, natural gas and crude oil, and some people would say 6 or 7 times natural gas value should be the price of crude oil, or vice versa. If crude oil is at X, divide that by 7, that'll give you the price for natural gas. Well, I can tell you that rule of thumb doesn't work. And so I don't subscribe to those type of ideas. I get the concept, but as a rules-based trader, we are trend followers. We take what the market gives us, and I'm not going to get pigeonholed into those type of things.
Do you ever look at the dollar as a commodity in and of itself? Does it trade like a commodity?
Well, it's an interesting question. We generally look at all markets like commodities independently and trade them based on their individual merit, whether that's those 12 commodities in the Auspice Broad Commodity Index that is the underlying to the COM ETF. We look at them independently. That's part of the edge of the strategy. We get long a market because it's going up, or, in the case of our CTA, go short a market because it's going down. So we look at those things extremely independently. And so to answer your question, yes, we look at it just like a commodity, and trade it independently. It kind of leads almost into a conversation about gold. And people say, well, gold is this key inflation hedge. You should have gold in your portfolio, because it has these inflation hedging properties. What I can tell you is, gold is interesting. I don't exactly know which category gold fits in anymore. We have it in the metals category for us, but is it, is it a commodity? Is it a currency? Is it a store of value? I think it's kind of all of those things. And so yet again, this is why we trade gold in, really based on its merit. What I can tell you, gold is not, and I can prove this mathematically, gold is not a great inflation hedge.
Yeah.
It simply isn't. If you look at times when inflation ripped, and all we have to do is look back to the summer of 2020, post the COVID initiation crisis, CPI went from nothing to 7-8%, and gold didn't move for 2 years. It started to in April of 2020, but then by September, and even in our portfolios, we got into it, and by September, it wasn't doing anything. Out it went, and we got long all other commodities in that 12 commodity basket, because they were moving. Gold was not. Now gold started to move, but again, I argue gold probably started to move for other reasons. But instead of trying to pick what the reason was, we look at these things independently. So what becomes a good inflation hedge? Well, gold we think is a great statistical diversifier. That's its value, and we have it even static in some of our portfolios. But we look at it and trade it based on its individual merit in general. If you wanted inflation protection out of 2020, you got that out of commodity exposure.
Yeah. Do you think when people talk about gold as an inflation hedge, maybe they get the timing wrong? So yeah, it can be an inflation hedge, but only if your holding period is 100 years, or whatever, right? It's like
sure, but
over time.
The same could be. So that's
the ebb and flow. I guess.
With you.
Yeah. So the ebb and flow is like for example, like in 21, like you said, gold didn't move, but then earlier this year it did move quite a bit.
Yeah.
While inflation's coming down, so the ebb and flow is sort of not really correlated with the inflation. So if you're hoping that, well, when inflation goes up, my gold's going to go up right with it. And so in that time that I'll need it because, the price of stuff went up, I'll be able to sell my gold. That's a flawed 100%. Thought. And most people, I don't think 100%. Look to own gold for like, a long enough amount of time to actually have it smooth out. And if they do, I think the math would suggest you probably would have been better off over that time period with your money being held in equities.
I'm with you 100%. So I think that's true. Like, if you've got that argument over that long period of time, own this commodity because it went up, well, why not own oil? I mean, it's been arguably the most important commodity of the modern era. I mean, in fact, I don't think how could somebody argue that? So own oil. I think, so it's funny when we talk about commodities and when the media talks about commodities, they talk really about two things, gold and oil.
Mm-hmm.
So very different. I think there's a lot of merit for oil for all sorts of reasons, but gold, well, what is it exactly? And so look, this is another reason back to the first principles. We look at each individual commodity based on its merit. What is it doing? Is it going up? Is it going down? Yeah. While we all try to debate timing and the fundamental reason, we're going to participate in the upside. We're going to exit or go short if it's going the other way, and completely agnostic in terms of what commodity and what direction. That is our overall philosophy. It's a risk discipline. I'm not going to debate why something is because I don't know and I don't have a crystal ball and I'm not omniscient. So at the end of the day, we need to be risk managers.
I think that's always the key principle I always tell people is if you manage the risk, you can let the upside take care of itself.
100%. I mean, look, we're patient investors and we had to be with commodities. I mean, we know the importance of commodities, but there were a bunch of QE factors and inflation factors and just market cycle factors that made commodities a tough place to be for a long time. So we had to be very patient. But even if we talk about the Auspice Broad Commodity Index, what does it do? It participates in commodities going up, and it goes to cash and markets going down. It's long flat, toggle in long flat. And why long flat? Well, because we know commodities will go up and we know they'll go down. Each individual market, the sector as a whole. And so we need to limit that downside. Yeah. And so we do that by stepping out of the market.
Yeah.
There's a structural edge in commodities that I think is important for investors to understand. It's what do I mean by a structural edge or a structural alpha in the space? And that is the way we participate in the commodity markets through futures is an edge. And here's why. Because the amount of money we as a manager need to put in a futures contract to create that exposure is very small, right? So that's judged by the exchange in terms of the volatility of that contract. But I don't need to put, $1 million down on $1 million worth of crude oil. I need to put a very small percentage of that. Mm-hmm. If we look at our strategies, and we've been around pushing 20 years, the average amount of money that we put in futures contracts is less than 7%. So we take in client capital, we create these exposures, and of that capital, we use on average less than 7% over 20 years. So what do we do with the rest of that capital? We invest it in cash, right? Cash return, right? So no risk. We just want a cash return. Well, for also that period of 10 plus years when commodities were tough to be in, we didn't get much cash return, as you know. That's changed. That's a structural edge we have in this space. We don't need to use much capital to create the exposures, and we can earn a cash return. So right now, even with the Auspice Broad Commodity Index, we can participate in those commodity exposures using futures contracts, put very little money into those contracts, invest the rest of the client capital in cash, and gain, a total return based on that cash return. And that return now obviously is reasonable, right? Yeah. 4 or 5%. So that is a structural edge or structural alpha in the space that people kind of don't understand. They think futures contracts are risky. Actually, no, futures contracts are great because there's always a buyer and a seller. There's almost, we say like it's not 24/7 liquidity, it's about 23/6. We can get in and out of those markets while only using a small portion of client capital and earning a cash return. That is an edge in the space that exists in very few markets.
Yeah. And I don't know how much more I want to unpack that. But that is quite significant. That could change though, if interest rates came down quite significantly, which I don't know that they really will, but I suppose
I don't have the crystal ball, so you're right. Could it change? And sure, it could. But I guess given where inflation is, do we think interest? Here's what I was, kind of say, and I don't know the answers to these things, but we all have to kind of, in Canada, so I say, we have to decide where the puck is going. So, do we think we're going back to QE, zero interest rates, zero inflation, and no market volatility? Do we think those four things are going to happen? I think it's pretty hard to make the case that happens. We're not going back to zero interest rates. Inflation is not disappearing. Volatility, I mean, come on, it's not going away. There's so many. Remember those structural drivers I was talking about? Forget commodities. Just think of the global effect on all those drivers that we see in the marketplace. Those are the things moving the market. And QE, well, that's a whole nother discussion. But I think that the reality is we are in for a normal period of inflation with probably at least normal volatility. There's so many things going on in the world, nationalism, populism, elections all over the place, that if we're good risk managers, there's going to be opportunity because there is going to be movement. And as long as there's movement, we have a shot at bat.
Volatility's opportunity.
Volatility's opportunity, and cash efficiency is an edge. Using futures contracts means great liquidity, ability to get in and out, and using less capital to do so means I can put that other capital and earn, a bit of a tailwind. Yeah. And so, I like our odds in terms of what we do. And I think, the agreement with the biggest global pension plans, conservative money, would agree with us. If you look at Ontario teachers, and I keep picking on it, they got 10%, as I said, in the sector. And there's an obvious reason why.
Yeah. Well, that's there's I feel like we could talk for 3 days about commodities and commodities trading, and there's so much that I could probably learn from you too. So I hope to continue to learn more from you over the years, Tim, and continue to stay in touch. I appreciate you spending some time to come on and chat, and hopefully the listeners, whoever they may be of this podcast, I don't know, but hopefully they found it interesting. There's a lot of opportunity in commodities, which certainly doesn't guarantee any return or anything of that sort. But there's opportunity to find non-correlation and diversified returns, right? You just have to have a real good strategy about how you're going to do it. So,
no, and I appreciate the opportunity. It's always fun to talk, and it's good to reconnect. It's been almost 2 years since I saw you in Dallas. Anytime you want to chat about things, even something more specific than just broad commodities, I'm happy to do it. So thanks for the opportunity.
Yeah, I think I have like a million more questions for you offline. But we'll chat more later, Tim.
I think I've got some questions for you. We have different roles in portfolio and asset management, so I've got questions for you too.
Yeah. Well, everyone listening, hope you had a good time. And if you ever have more questions about this stuff, feel free to reach out. And I'm happy to field questions about this space. And if we need to bring Tim into the conversation and get more clarity, we can reach out and see if he can find some more time graciously for us.